In today's video, I'm going to take you through my top 5 undervalued ASX stocks to buy in December 2020. Before we get into the content of the video, guys, please note this is not financial advice. If you need financial advice, please go seek it. Read this disclaimer. Just want to cover off all bases before we get into the video. Okay, so my first pick is Oil Search, ASX ticker OSH. So guys, Oil Search is an oil and gas producer based in Papua New Guinea, PNG. It was established in 1929 and is the largest company in PNG. It operates in PNG, Australia and Alaska. It was particularly hit hard by the March 2020 COVID crash, along with a lot of other oil and gas companies. And it actually went from $7.70 all the way down to $2.20. So I suggest if you do want to invest in this company, take a look around, have a look through their website, go through the Investor Center and ASX releases. But what I'll do now is take you through some of the key financials and also my investment thesis. Okay, so Oil Search, as you can see at the moment, is trading at around $3.65. As you can see, it was hit really hard during COVID, and it's kind of established a bit of a base for itself and had a little bit of an uptrend recently. Whether or not that continues, we don't know yet. But one thing's for certain is that this has been hit hard, guys. So it isn't a small company by any means. It's 7.58 billion, and at the moment, it generally pays a decent dividend. At the moment, it does not. Because I believe it has been cut, so it's sitting at around 3.47%, but I do expect that this may be cut. Okay, so it does have a lot of shares trading daily. Its volume is 8.6 million on that day and 9.8 million on average, and as you can see, it's kind of picked up recently, which is a good thing, especially given that we're starting to see a little bit of green in the on the horizon. So guys, my investment thesis is pretty simple. This was one of the hardest hit stocks in the ASX 300 during the COVID crash, and therefore it's a key beneficiary of the recovery trade. So the recovery trade, guys, is basically anything that got smashed really hard during COVID and its earnings were hit. The recovery trade is anything that was hit. These will be the things that benefit the most through the recovery period that we're in now. Okay, so things like travel, things like oil companies, these things were hit hard. So in that reversal, in that reverse trade, they're going to see the biggest benefit. Okay, and this is where you're going to see some really good growth in companies like this. So this is where you can, potentially in a short-term trade, manage to make a quick amount of money. So oil and gas is still going to be needed by the world, and the price has been beaten really hard, guys. It is a cyclical commodity, and it will at some point recover. So it is in a cyclical low point. And once this recovers, Oil Search being one of the smaller ASX, it's definitely not the biggest. It's not Woodside Petroleum. This thing will benefit greatly from an increase in the oil price and an increase in the recovery trade thesis. Management have been focused on cost cutting lately, guys. So they've reduced the capex, so the amount of money they spend each year, by about 40%, and they've also decreased production costs. So 2021 looks like it will be a year of vaccines and strong economic growth, which should benefit this stock. Okay, so definitely one to add for your December watch list. Guys, if you do want a slightly less risky play to this, then I'd suggest Woodside Petroleum being the least risky, and Santos. Both of these are oil and gas companies, and they are better capitalized and a bit safer. The reason I've recommended Oil Search is you do have the opportunity to make more money. Your downside risk is obviously bigger as well because of that. So guys, the next company is Treasury Wine Estates, ASX ticker symbol TWE. So guys, Treasury Wine Estates Limited operates as a wine company primarily in Australia, New Zealand, Asia, Europe and the Americas. The company's got a really impressive portfolio. As you can see there, you probably have drunk some of these wines at home. It sells them to the whole world, and it's got some amazing brands such as Penfolds, which I'm sure you've heard of, Beringer, Lindemans, Wolf Blass, all very popular brands, 19 Crimes, Chateau Saint Jean, and a lot of other very, very popular brands. It markets and sells its products to distributors, wholesalers, retail chains, independent retailers, and on-premise outlets, as well as directly to consumers as well, guys. As you can see, guys, these are a global leader in the wine industry, and they are a really, really well established marketing brand at getting these products and increasing distribution. Okay, so it is a powerhouse at increasing wine companies' distribution, and so those they're able to get their products into really big chains like Dan Murphy's and the like. They also obviously sell direct to the public as well. I'll take you through some of the key financials now. Okay, so as you can see, again, a similar chart. COVID has been hit really hard because of COVID, and on top of that, there have obviously been some China political issues with Australia and some tariff issues as well. So as you can see, its 52 week trading range is huge, going from $19.16 all the way to $7.87. It's currently at $9.23, but it has been whacked really hard. As you can see on this particular day, it was down 11.25% against some tariff issues, which aren't good for it. But let's get into a bit more about the company. It's obviously not a small company. It's 6.65 billion. It's been a bit of a market darling, as you can see. December 2015 to July to June 2018, that was a big run up where it's well more than doubled in size. So it's a highly traded stock. It is trading on a little bit of a high PE, especially given that its earnings may take a whack. So it's at a PE of 25.5. Now, what I do suggest with this one is that potentially there is a bit more pain to come with this stock, but what I'm thinking is that the current issues it's facing are temporary. But more of that in a second when I take you through my actual investment thesis for Treasury Wine Estates. So guys, it has a really, really great portfolio of wine brands, and why I like that is brands matter, especially in the wine space. People are loyal to those good brands and they will buy them day in, day out. Wine drinkers will buy many wines and actually store them, and also they tend to drink them regularly. So when they keep buying those brands that they love, obviously their lifetime value of that customer is really high. So these, Treasury Wines has good brands, and therefore people buy more of them, and then this business is better because, say a wine company doesn't have as good of brands, then it's not going to do as well as Treasury Wines. So the great brands really do matter. It gives them a moat, okay? So you probably heard of Warren Buffett liking companies with a moat. These guys' moat is their actual brands that they're able to range. There is a lot of bad news baked in the price at the moment, guys. So this has been hit really hard. So any small positive or overperformance or anything easing up, so China political tensions easing or the tariffs being lifted, this could lead to some really, really big gains. The other thing to note is that Treasury Wines is backed by a large amount of value compared to the share market is pricing it at. It has over $1 billion in premium wine stock on hand. Okay, so it's got a lot of actual real value within it. So it also owns some high quality farmland in Napa Valley and Barossa, which is obviously worth a lot of money as well. And there is still really strong demand for premium Australian wine in China. People are shifting away from beer and spirits to wine. So it still has that tailwind there, and so you would expect it over the long term to still benefit. So guys, some key risks are price has had a quick sharp drop and it could keep falling. Okay, it may test that previous $7 mark. So potentially a wait and see. If you are a long-term holder though, it's probably a good time to get in and hold over the 3 to 10 year horizon. Tensions with China may last longer than we think, okay? So any escalation would not be good for this company. Any additional tariffs or any kind of political issues between Australia and China are not going to be good for this stock. So just something to consider before adding it to your portfolio, especially if you have a lot of stocks like A2 Milk and other companies that are already exposed to China. If you have lots of companies exposed to China, any hit is going to hit your portfolio really hard. Okay, so the next stock, guys, is Unibail Rodamco. So guys, what do? These guys are a commercial property giant. Their ticker symbol is URW. It's Europe's largest commercial real estate company. It has assets in continental Europe, the UK, USA, where the company owns an impressive array of shopping centres, convention centres and offices. And I know I've probably lost you at shopping centres, but please stay to the end of this to find out why I'm recommending it. The REIT acquired Australian shopping centre operator Westfield Corporation. So you've probably seen Westfield's, probably been to one. So it created, it acquired this, created by the split of Westfield Group in 2018, which is when these guys actually listed on the ASX. So I believe they're also listed in France as well. So there's a dual listing there. So as you can see, this has been really hit hard again, guys. So trading from 11.59 all the way down to 2.41. It has had a resurgence of late, but this is one to watch, wait and see. It's got a really high dividend yield of 10% there. And its market cap is 13.7 million. These guys own some terrific pieces of real estate, and look at that PE ratio, 2.9. Now, it's not always a good thing to look just at a PE ratio because, there could be more pain to come with this stock, but this is a really, really strong potential recovery trade. So definitely one to keep an eye on. My thesis is pretty simple, guys. It's one of the most beaten down and hated stocks and bang in the most banged up sectors. Okay, so it's in a sector, commercial real estate, which has been hit really hard, particularly in the shopping center space, and many of its properties, in the countries hardest hit, like France, hardest hit by COVID being France, obviously has suffered a lot. A lot of that is baked into that share price. So any small change is really going to, as you can see, this stock on some days has been up 35%. It's definitely one to watch, okay, especially over the longer term. A lot of these trends here could be greatly overdone. So these theses that, commercial real estate is going to decline massively and never recover, a lot of this may be overdone, okay? And having some exposure to this stock would be good for someone that is, I guess, a contrarian investor, someone that wants to go against the grain, against what everyone thinks. Obviously, on the flip side, it might actually be true as well, right? So obviously, you wouldn't want to put too much into this, but it might be a bit of a short-term trade or a longer-term hold for someone that believes that this trend is not real and it's just a temporary blip on the radar. So similarly, the shift to online has many investors scared of what will happen to traditional mall and shopping center retailers, the owners of those shopping centers. Again, if it's overdone, there's going to be some really big upside on this stock here. So guys, I hope you understand why I've recommended this. Do I think it's the world's greatest company? No. But potentially what's happened here, guys, is there's a lot of bad news around this stock, and any small amount of increase, surrounding COVID vaccines or, online retail not growing as fast and it's just temporary, or, commercial real estate prices still being strong, or retail, so the retail sector doing well, then this is going to benefit in a great way. And, it may never get to its previous high, but, maybe $7, $8 could be on the radar. Again, do not buy a huge position in this, as the risk is there, but obviously there is some big upside as well. So the next stock, guys, is Bravura Solutions, BVS. So this company is a little bit smaller than the rest of the ones we've been covering off, guys, but what I do like, it is a software company, which is something that a lot of people obviously like, being in the tech space. So it provides software solutions for wealth management, life insurance, and funds administration industries. So industries that do have money to spend, which is awesome. Their solutions are used by many leading global financial institutions such as Fidelity International, JP Morgan, Citi, and Lloyds. Now, I'm sure a lot of you haven't heard of this stock, but their flagship product is Sonata, a next-generation wealth management administration system that helps businesses reduce operating expenses while increasing customer connectivity and engagement. Okay, so these guys are actually able to help fund managers who have a lot of money and operate in a very, very complicated space. They're able to help them actually grow their businesses and better manage them, which is something that most technical companies, most companies that require a lot of human intervention, if these guys can come in, remove some of that human intervention, and actually extract more value from their customers, then it's obviously a win-win. And obviously, this is why this stock has done well in the past. Now, the reason I'm recommending it, guys, as you can see, it has come down well off its highs. A lot of it, again, due to COVID. So it's come down from almost $6 at $5.98 down to $2.85. It has come up again a little bit, but it hasn't really enjoyed much recovery. Now, for something of this nature, guys, it's a fast-growing company. It only has a PE of 20, which may sound high, but if you look at that, for a tech company to have a 3.2% dividend yield and this thing is still growing, then something's up. Either we've vastly underestimated what they're going to do, or COVID has actually really had a long-term impact on the business. We're going to ascertain that in a second. It's got a market cap of 813 million, so it's by no means a tiny company, nor is it a big one. So let's get into my investment thesis. Okay, so let's get into my investment thesis for Bravura. So number one is COVID lengthened and complicated sales cycle. So if you go through any of their recent updates or reports from management, COVID has really made a bit of an issue with, people working from home. A lot of these businesses are harder to contact. There's less people available. So all these funds obviously sent people home. And so it's actually made their sales cycle, which, obviously may have been a couple of months. It may have blown out now to several months. Okay. So basically what's happened is it takes a lot longer for them to convert a lead into a customer, which is not good, which means that earnings have slowed. Brexit has also impacted sales, as a lot of their financial customers are based in England. Future sales pipeline, though, is really strong, guys. So the above is likely just to be a temporary blip, and so we might be able to pick this company up over the long term at a really attractive price, making this very undervalued. Customers really like the product, guys. They've got sticky recurring revenue model, which is something I really like to see, because customers, once they sign up to this, they're not likely to leave because it's obviously going to cost too much, and it's much easier just to stay with them. They're also in a net cash position, so they're well strong enough. They're definitely strong enough to weather the COVID storm. They've got plenty of cash on hand. They're still making money. It's obviously just taking a lot longer to get a sale, and it's got an undemanding valuation for a tech stock, being around that 20 PE. I really like this one, guys, so I'm going to be purchasing this one probably this week, and then probably holding for the medium to longer term, because I think it's a great company. Okay, so my final pick is Insurance Australia Group, ASX ticker symbol IAG. So what do? They're the largest general insurance company in Australia. You would have seen them. You may even be insured by them. Provides a range of personal and commercial insurance products, primarily motor vehicle and home insurance. So if you own a home or a motor vehicle, you're probably covered by either these guys or Suncorp or QBE. So it's headquartered in Sydney with operations in Australia, New Zealand and Asia. So they have expanded out there. And IAG's businesses underwrite almost 12 billion of premium per annum, selling insurance under many leading brands, okay? So as you can see, it got hit really hard in COVID, and obviously, it had a really good run from 2015 to 2018. It had a little bit of a drop, and now it's come way back down. So its 52-week trading range is quite big, trading from all the way from $8.15 down to $4.38, and it hasn't really recovered that much, unlike a lot of the share market. So it's only at $5.32. It's got a decent sized market cap at 12.98 billion. It's got a PE ratio of 28.76, which, may insinuate that earnings may be dropping a bit. It normally pays a decent dividend, but at the moment, I believe that's been scrapped due to the issues that they've been having with COVID. So guys, my investment thesis is, again, relatively simple. Insurance companies have been hit really hard during COVID. Obviously, businesses have had to shut down. They've had more claims, and it's probably slowed down their sales cycle as well. Business interruption claims have spiked massively during COVID as well, and they've had a case in the New South Wales Supreme Court that went against them, that said that a lot of the exclusions and disclaimers they haven't actually prevented them from excluding people during this pandemic. So after SARS, they included a lot of little disclaimers that during pandemics they wouldn't pay for business interruption insurance, but it looks like they may have to pay these, and that's why the share price has struggled of late. Volumes are starting to pick back up on the stock, though, which I do like. And it's done a capital raising to boost its balance sheet so it can weather this storm. But what I think will happen, guys, here is they're going to have to raise premiums. Everyone's going to have to pay more for insurance to offset a lot of these costs. And it's the perfect stock for a recovery trade or rotation into value. So value has been doing really poorly. So stocks like this have obviously not done well. You add in the issues with COVID, and insurance companies are one of the most hated places to be right now. So for some potential exposure to, one of the best insurance companies in Australia, and also Warren Buffett's company, Berkshire Hathaway, actually has a stake in this. So I don't believe they would put their money in something that they didn't believe in. So over the longer term, I believe IAG may be a great buy to pick up now and hold for the next 5 to 10 years when everything returns back to normal. Okay guys, thank you very much for listening. I hope you've enjoyed the video and it's given you some stock ideas. I'll see you in the next video.